Imagine a massive web of secret debts hiding in the shadows of the global financial system. Trillions of dollars, hidden borrowing, from shadow banks, off-balance sheet tricks that no one fully sees. One sudden shock, and it could all unravel overnight, crashing economies worldwide. Let's zoom into shadow banking. That's non-bank players like hedge funds, private credit firms lending huge amounts with lighter rules than traditional banks. They fuel credit through repos, derivatives, SHID deals. Non-banks lend freely global shadow assets to...
The big cause? Maturity mismatch. Making everything more fragile.
Players, hedge funds piling on leverage via repos, China's local financing vehicles drowning in hidden debt from infrastructure booms. Big banks connected through derivatives. The turning point, rising interest rates or a market dip exposes the opacity, lenders demand better collateral or pull out entirely. Here's the peak drama. A liquidity crunch hits, repo rates spike, funds can't refinance, forced sales crash asset prices. Leverage amplifies losses, a 10% drop could wipe out trillions through chains of debt. Like Lehman in 2008, but now on a global scale with shadow networks interconnected everywhere. Consequences are brutal. Credit freezes, banks take hits from linked exposures, stock markets plunge. Economies slow as borrowing dries up. In developing countries, hidden sovereign debts trigger defaults. Globally, it spreads fast. One collapse pulls down supply chains, trade, and jobs.
Happened next in past crises. Central banks pumped liquidity, but reforms didn't fully fix shadow risks. Today, regulators warn of data gaps and rising leverage. Lessons: more transparency, limits on hidden debt, and monitoring non-banks could prevent the worst.